Now we get to pick up on China and Asia in general, and what are some of the things that are adjusting in the region. Now that Omicron is continuing to rip through, the death toll is climbing, which is, I think, expected given the fact that it's now more of a full opening. The issue is going to come down to what happens for Lunar New Year. Do people stay home to try to avoid going back to see family? Because a lot of people are from the rural part of the country, and do you want to see grandparents, or are you going to let this one ride out and then go later on in the year? So we do think that there's going to be a very difficult Q1. Things will get better as we get into end of Feb, March. But that's also going to play into just the end of flu season, the end of winter, moving into spring. And that, I think, is going to be another of the backdrop of why we should see some strength going into Q2 after seeing a lot of weakness in Q1. The China Beige Book, they have a ton of good data and charts. You get an idea for fiscal activity in Q4. And you get an idea of just how low it was. So again, things just closed out terribly. But how many people are really surprised by that? I would say not many, just because they still had lockdowns that didn't really change until the early part. Let's call it the second week of December. Now you have the Bloomberg Economic China Monetary Conditions Index is kind of flat. We don't see that changing. We don't see a lot of liquidity coming in. We don't see a lot of PBOC support. And that's something that is going to be continuous. And there's some other data sets that also support that. China manufacturing PMI survey was for 47.8, came in at 47. Get an idea of just how steep that was. And it's really coming down to, yes, things did reopen, but when you reopen, you also had a massive amount of infections start. And as the infections start, well, then you have to stay home. So it's just because you're reopening and allowing people essentially to get infected, you're still not going to see this big turnaround in manufacturing activity. And depending on how things adjust in January, things will remain weak, at least in the first 2 weeks. But how things pivot in the second half of January is going to be indicative of where do we sit in this. We still think it'll be in contraction, but does that mean it's at 49.5 or 48.5 is really going to be how quickly do things normalize, a bit on the manufacturing front. New orders is telling you that it's not going to adjust all that much. You can see it's down to 43.9. Again, new orders, if you think about China is still an exporting nation. If you're not getting new orders, you're not going to manufacture. So you're still just not getting anything through, which fits back to the question of, well, if China reopens, it's a positive. But if the world doesn't need Chinese goods, well, then how much will the reopening really drive the next leg of recovery, which is another reason why we see some additional headwinds in the region. Now, when you look at employment is a huge overhang. When you look at from manufacturing, because yes, do the Chinese have more in savings than ever before? Yes. Are they then do you have to think about Asian nations? For the most part, Asian nations and Asian people are more savers than spenders. So they were already starting from a higher level. Now you have employment a problem. And because 65% of the populace is exposed to the real estate sector, well, the real estate sector isn't coming back. Many people might have gotten wiped out or taken massive losses. So how much are the savings kind of offsetting some of the losses? And that's where we don't see this just dumping into the market. Non-manufacturing PMI was expected to be at 45, came in at 41.6. Again, all of these will bounce. I don't think that is even a question in January. In January, the question is going to be bounce to where? Are non-manufacturing going to go from 41.6 to 47? Sure, that's highly likely. But where it is it 46 or 47 is going to be where are we by the end of January in terms of the infections, in terms of the death tolls. Then how much do we see this reopening continue? Or I should say, the pace of the reopening, because the reopening is going to continue. But one of the things for those that watch us regularly or every so often, we were saying that, look, the reopening is now happening, but just because the government says you can go move around, but you as a consumer sitting there saying, okay, well, everybody I know is infected. The infection rates are exploding. I don't feel great. Do I want to go expose other people, or do I want to be exposed? Will you go food shopping? Yes. The question is, will you go food shopping twice? Will you go to a retail store? If you're looking at the infection numbers, you're like, I'll give it a week. I'll give it a month. So will we get more activity? Yes. But as we said in December, it wasn't going to be in December. And depending on how quickly the infection spread and the recovery comes behind it, will dictate, is that recovery in January or February? And then, how much of the recovery, and will that move us back into expansion? Because when you look at non-manufacturing, every time we had a reopening, we never went, meaningfully back to the 55 that was normal between 2016 and 2019. Instead, we had a spike and then a fade, and that's something that we would expect to be something similar. Now, when you look at non-manufacturing new orders, again, giving us the confidence that January is not going to be all that great. When you look at, well, what are the new orders coming? There's clearly not there. And they've been, even in a reopening, they spike and fade instantly because we just don't see that kind of traction. Employment has been moving in a downward trajectory. It has been since 2000, essentially back through 2017. And I should say 2018. And you can see it's just getting worse. And now, will it bounce? Yes, but again, not in a meaningful way. So then when you look at the Caxton side, Chinese manufacturing PMI expected at 49.1, came in at 49. New orders, though, rolled over, came in at 48.2. So again, more of this leading indicator where January is not showing anything better given the new order side, given where manufacturing sits. Could it bounce into expansion? It'll likely, based on the way Caxton is calculated, it could bounce to 50.5. But again, we don't see too much of an expansion in new orders, which is going to keep any upside really weighted down and under pressure. So then when you look at manufacturing future output, that's gotten better. Why? Because we're no longer in a lockdown. We're seeing more expansion. We're seeing more activity. So the future output should be better. The question is going to be how long does that really last? Especially when you look at Chinese credit impulses. So as we've been saying, credit impulses were going to massively disappoint in 2022, and we don't see that changing. Even though there's a push to stimulate, we're not seeing a lot in infrastructure. We're not seeing willingness from the PBOC. We're seeing a more of a push from the CCP, trying to drive activity, trying to push this debt and the stimulus through. But again, everybody is so levered from the consumer to the industrial to the corporate side. Just because you're offering the debt doesn't mean there's anyone to take it. And that's something that we continue to see. When you look at Chinese infrastructure investment, is set to slow. And when you look at overall infrastructure investment, they've been pushing it through, but local government special bond new issuance has rolled over. And I think when we look at the audit, how much can we trust the audit is always the question. We're going to see additional adjustments down in terms of the activity and what is just happening in the market where we don't see that cycling through of money. Proportions of loans from banks versus non-bank lenders, you're seeing more shadow banks again, that non-bank side, because, some of these, even though the CCP is pushing for people to get new debt, even though the PBOC is making things cheaper, it doesn't mean that you can get it based on credit quality. Even though the PBOC is saying that you can, the CCP is saying, no, you have to. Well, some people and some banks are like, look, I know what you're saying. My balance sheet doesn't support it. So you're seeing more people and more companies, especially on the real estate side, go to the shadow bank again, which kind of works against what the PBOC has been trying to do to try to minimize that shadow banking, because that's when you started to get some questionable moves, and that was a big problem which they've been trying to fix, and this is taking them a bit backwards. Sales, revenue, and profit margin, as you can see into Q4, continue to diminish. And we see that continuing to be fairly weak in Q1, but not a continuation down, just more of a sideways move into Q1 with a little bit more revenue. But margin is not something that we think is going to be very strong. You might get some additional revenue, but again, the profit margin is going to be, I think, on the weaker side. Now, when we turn to Vietnam, a big sharp reduction in output and new orders, firms scale back employment and purchasing activity, output prices lowered for the second month running. So you're seeing pressure in Vietnam while they raise prices on gasoline and diesel. So we think there is more downside on the manufacturing front. And this is what we were talking about now, not only just China, because China, again, pulls a lot and imports a lot from ASEAN nations, but we see a continuation to the downside because even as China gets back to normal to a degree, new orders are still low. They still have a lot of inventory. There's not going to be a huge impetus to go out and buy more from Vietnam. And again, that's going to create more pressure on the emerging market front, which is what we've been saying. So then when you look at South Korea, industrial production slightly better, expected to be at negative 0.8, came in at positive 0.4. That's for November. We do see that slowing in December based on some of the leading indicators we've talked about. Leading index change came in at negative 0.2. Retail sales slightly better, but department store sales slightly worse. Discount store sales, again, better. CPI still remaining elevated, still sticky and above where they want it to be. And that is a problem when you look at some of the different cycles that we've been talking about and why their central bank is going to continue to keep those rates moving higher. Not at like 75 basis points, but still at a 25 to 50 basis point clip. Exports were expected to be down negative 11.1. Instead, they were down negative 9.5. But as we've been talking about, imports are a very important piece to that. Imports were supposed to be down 2.2. Instead, they were down 2.4. So you still have that lag that we've talked about when you look at those leading indicators of imports and more of that pressure to the downside, which is where we see more concern in terms of just general South Korean activity. Then when you look at Taiwan, soft but still severe falls in output and new work, which means that you still had a bounce, but it still looks ugly and it's not getting much better. So firms cut selling prices despite uptick in costs. Now that's a key piece because they're sitting on a lot of inventory and they're starting to see their costs go up. And again, raw material side, that is something that's common. And then on the manufacturing front in South Korea, fastest contraction in order books since June 2020, softest rate of selling price inflation in 27 months. So some of the leading indicators for inflation are getting better, but new orders, fastest contraction. Again, there's a lot of pressure that we're seeing in the ASEAN world, in Taiwan, in South Korea. And again, that's where we see more of that concern because when you look at activity, that was where the strength was, and now we see that starting to roll over. India, on the other hand, had a nice bounce. Output growth reached 13-month high, fastest rise in new orders since February of 2021, supports job creation and boosts input purchasing. Services on that side also saw an acceleration. This is opposite of what we were saying. We thought India was going to accelerate more to the downside. Instead, we saw a nice pop. Now, we did have, they do have a fairly strong holiday season in December. We do see some downside to January, but it's still going to be in expansion and is going to remain a bright spot at least for another month or two based on some of these leading indicators, versus a lot of the other options in the area. South Korea CPI year over year expected at 4.6, came in at 4.8. South Korean consumer confidence 89.9. So you can see that the CPI is still going up. Some of these moves in India, while they're good, we do see them a bit inflationary. So even though you're seeing some of this kind of sideways move, you still have an inflationary pressure point, and you'll still see some of these pressures moving. And as trade slows, again, cycling back to segment one, we see India as the one that has the most to lose at this point, just because they've done the best. So it's not that they're gonna go negative. It's just that on a year-over-year, month-over-month basis, that's where we see some of the largest downward moves, even though they're going to be positive. China should have some positive moves in Q1, but again, it's still going to be in contraction, just better than it was, where India is still going to be in expansion, but worse than where it was. So kind of the other side of that coin. Now, when you look at India 8 core output indexes, still staying strong. We see it remaining, as we were saying, we expected to kind of flatline here. So we didn't, as we said last month, we didn't see that drop. Instead, we see things moving sideways. But the current account balance is the biggest concern when you look at the deficit, when you look at where inflation is starting to pick back up. So it had a surprise to the downside in last month's release. We see a bit of a surprise to the upside, and that's going to put some pressure on some of those rates. And now Japan had its fourth unplanned bond purchasing last night. And that's where, again, we see just more pressure, and the market is just going to continue to push. And when you look at non-residents, net investment in Japanese bonds, massive sellers, largest selling that we've seen since essentially they broke the peg, or I should say the Operation Twist. And they're just putting more pressure on it. We expect more selling, and we expect the BOJ to yield once again, as we said in, I think that was October of last year. So that's what we have for you today. If you have any questions, please feel free to reach out. We'd love to hear from you in the comment section. Please like, share, subscribe. We appreciate your support. And if we could get some additional support in 2023, that would obviously be fantastic. So we hope you had a great holiday season and a great start to your new year. I'm Mark Rossano, founder and CEO of C6 Capital Holdings, coming to you from Primary Vision Network.